to make money in the stock market is through options trading. Now, options trading can get a little bit confusing, but I'm going to try to keep it simple and explain it in a way that's simple to understand by talking about the call option method. Let's say you own 100 shares of stock in Coke. You bought Coke for 55 bucks. You're making money from Coke because Coke pays a dividend. They pay a dividend every quarter. So every quarter you're getting dividend checks, you're getting dividend payments. But you're not satisfied. You want to make even more money from your shares of stock in Coke. So what you end up doing is you end up writing an options contract. You end up writing a contract. So in that contract, you're pretty much saying that I'm willing to sell my 100 shares in Coke at 60 bucks. 60 bucks, also called the strike price. The reason why I say 100 shares of stock is because an options contract is usually a lot of 100 shares. Now, if the buyer of this option contract agrees with my contract, he has to pay me a premium. Now, a premium might be $1 per share on this options contract for Coke, for my 100 shares in Coke. Now, the premium could be influenced by a multitude of things. If the options contract is for a stock that is popular, it's gonna have an impact on the value of the premium. The closer the actual price of the stock is to the strike price, that means that the premium is usually gonna be higher. But let's stick with $1 for one share in Coke, and an options contract, it's a lot of 100, so we're getting a premium of 100 bucks directly deposited into our brokerage account. So let's talk about how the seller is making money then. So I'm the seller in this case. If Coke, which I bought for 55 bucks, never went up to the strike price, which is 65, more than likely the buyer is not gonna execute the options trade, because why buy Coke at 65 when it's trading below 65? So I just made some additional money without even selling my shares in Coke, because I still own the shares and I made a quick 100 bucks. Now, even if the options contract did get executed, I would still make some money, because let's say I bought it at 55 and then the stock went up to 60 and it went past 60. The options contract gets executed and the buyer buys my 100 shares at 60 bucks. I still made a profit of 500 bucks plus the additional 100 bucks, because I bought it at 55, it went up to 60, so that's a $5 increase. I own 100 shares in Coke, so 5 times 100, I made a profit of 500 bucks plus the premium, the $100 premium. So I just made a profit of 600 bucks. From the buyer side, I'm already $100 short. I'm already $100 in the hole because I had to pay that as a premium to the seller. Now, if Coke never goes up to 60, I'm not gonna execute that options trade, because why buy Coke at 60 when it's trading under 60? But here's the cool thing. If Coke goes up from 55 to 60, I execute the trade and it ends up going to 65. Now I just potentially made $400 in profit, because let's look at this. So Coke went from 55 to 60. I execute the trade as the buyer, and then it goes from 60 to 65. Now I just made a $5 profit per share and I own 100 shares. So that's 500 bucks. It's still unrealized, of course, so I end up selling at 65. Now I just made a quick profit of 400 bucks. Why? Because that 500 bucks minus the premium of 100 bucks gives me that $400 in profit. That's pretty much how you want to look at options trading simplified.